So you've spent a lifetime, maybe 30 years, maybe more, pouring everything you have into building your business. It's not just a company, it's your legacy. And now you're looking at the single biggest financial event of your life, selling it. The key to making sure that legacy is protected is getting your financials ready before you even think about going to market. So let's walk through exactly how to get that done.
For decades, you and your CPA have been playing one game, and you've gotten really good at it. The goal? Simple. Make your profit look as small as legally possible to pay less in taxes. It's smart, it's what you're supposed to do. But the second you decide to sell, the entire rulebook gets thrown out. The game completely flips. Now your goal is the exact opposite, to make your profit look as big and as provable as possible. And look, here's the tough reality. If you just hand over your tax-focused books to a sophisticated buyer, their team of accountants is going to rewrite your story for you. They will use your own numbers, the ones designed to minimize taxes, to devalue your life's work. It's a painful process called a retrade, and it's basically when they slash their offer price right before the finish line. We're here to make absolutely sure that does not happen to you. To do that, we've put together a really clear, actionable playbook. First, we're going to build your proactive financial defense. Then, we'll get into the multi-million-dollar math so you can see just how high the stakes are. After that, we'll dive into the add-back playbook, get you organized for a smooth sale, and then wrap it all up with a simple 24-month roadmap to get you there. Let's jump in. Okay, so if it's a new game, how do you play it? Well, your single best tool, your secret weapon, is something called a sell-side quality of earnings report. We just call it a QOE. This is your proactive defense. This is how you tell your story on your terms. Now, it's really important to understand what this is. A QOE is not for the IRS. You should think of it like a professional resume for your business. It's an independent firm taking a deep dive, reframing your numbers to show a buyer the true, sustainable earning power of your company, and it does this before they get a chance to tell their own story with your numbers. So what does a QOE actually do? Well, a few critical things. It finds and proves those add-backs that drive up your value. It stress tests your books for things buyers love to pick apart, like inventory. It figures out your real working capital needs, and, this is a big one, it uncovers any hidden debt-like items that could give you a nasty surprise at closing. It basically creates this bulletproof evidence package that gives buyers confidence and makes the whole deal go faster. That all sounds good, I know, but let's get to the part that really matters: the money. The direct, quantifiable return you get from this kind of preparation. This is where you'll see why it's so incredibly important. Here's the key concept to lock in. Your business isn't just valued on one number, it's valued on a multiple of your earnings. And that means every single dollar of profit you can find, prove, and defend gets multiplied. We're not talking about addition here, we're talking about multiplication. And that has a huge impact on your final price. Let me show you what I mean. Let's look at a super common scenario. Okay, so your books show earnings, or EBITDA, of about $1.2 million. A buyer comes in, their accountants challenge a bunch of your expenses as being part of the normal business, and they try to push that number down to $850,000. But because you did your homework with a QOE, you have the proof, the invoices, the contracts, to show that actually $250,000 of those costs were truly one-time things. You successfully defend your earnings and get them back up to $1.1 million. So, what does that mean for you? It means this. Over $1.6 million. That's the amount of value you just protected in a very, very realistic scenario. And here's the simple, powerful math behind it. That $250,000 in earnings you just defended, you multiply that by a pretty standard market multiple, let's say 6.5 times, and that equals $1,625,000 in your company's value. You might spend $50,000 on a QOE report, but as you can see, the return on that investment can easily be 10, 20, or even 30 times its cost. Okay, so now that we're crystal clear on why this is so critical, let's shift gears to the practical how-to. This is your playbook for finding and, more importantly, proving these adjustments that drive your value up. We call them add-backs. So what makes an add-back legitimate in the eyes of a skeptical buyer and their bank? It's not a guess. It has to be defensible. And that means three things. 1, you can point to the exact line item in your books. 2, you have a piece of paper, an invoice, a contract from someone else to prove it. And 3, you have a logical story for why it's a one-time thing or just bringing something to a normal market rate. Let's run through the most common ones. Are you paying yourself or your spouse's salary way above the market rate? Great. You can add that extra amount back.
but you need payroll records and market salary data to prove it. Did you have a one-time legal battle? You can add that back, but you need the settlement papers. The main takeaway here is simple. For every single claim, you need a clear, third-party paper trail. Documentation is what gives you credibility. So here's a pro tip that'll save you a world of headache. Don't wait until you're selling to try and dig all this stuff up from 5 years ago. Start now, today. Just open up a simple spreadsheet. Every month, you list any one-time expenses. In one column, what it was. In the next, the amount. And in the third, a link to the scanned invoice. I promise you, this simple discipline will pay for itself 10 times over. Now, having all this great evidence is half the battle. The other half is presenting it in a professional way. And that happens in what's called a virtual data room, or VDR. It's just a secure website where potential buyers can go to review all of your company's documents. A messy, disorganized data room tells a buyer you're not prepared. But a clean, logical one, like you see here, shows them you're serious and you know what you're doing. See how it flows? You start with the big picture financials, then you present your professional QOE report, and then you have all the folders with the proof to back it all up. This puts you in the driver's seat from day one. A good QOE also digs into your balance sheet to find hidden risks, things that can actually reduce the amount of cash you walk away with at closing, so you have to get out ahead of them. You need to analyze your working capital, find those potential debt-like items, things like deferred revenue or vacation time employees haven't taken, and you clean all of it up before you go to market. The goal is 0 surprises. I know this can feel like a lot. It can feel overwhelming, but the key is that you don't do it all at once. So let's pull all these pieces together into a simple, manageable timeline you can actually follow. Here it is, your 24-month roadmap to a successful sale. You start 2 years out with that simple monthly tracking we talked about. At 18 months, you get a formal analysis of what your market rate compensation should be. At the 1-year mark, that's when you hire a firm to do the sell-side QOE report. And then, 6 months before you hit the market, you get that virtual data room all built out and finalized. See, when you break it down like this, it's not a panic, it's a plan. So after seeing that roadmap, it's probably a good time to do a quick, honest check-in with yourself. Let's figure out just how audit-ready your business is right at this moment. Just run through this list in your head. Do you track your ad backs every month? Is your own pay benchmarked? Are your revenue policies actually written down somewhere? Now, if you're sitting there and you can't check very many of these boxes, don't panic. That's actually a great sign. It means going through this preparation process is almost guaranteed to create a ton of value for you. Let's just tackle the 2 most common objections I hear head on. First, my CPA already did my books. And you know what? I'm sure they did a fantastic job for the IRS. A QOE is a totally different tool for a completely different audience. The second one is, a QOE costs too much. But as we saw with the math, the reality is that by protecting your company's value from that painful retrade, a good QOE doesn't cost you money, it makes you money, often with a 10x or higher return. So we'll leave you with this thought. After pouring your entire adult life into building this business, protecting its value during the single most important transaction you will ever make, well, that's not really an expense. It's the final and maybe the most crucial investment you'll ever make in your company. The real question isn't whether you can afford to prepare, it's whether you can possibly afford not to.